Testing 1, 2, 3, and we're live. How you doing, friends? Ernie here. With, let's see, who am I with today? I am with Asymmetric Advisor, because we're talking about gold. We're talking about natural resources. And the thing that I've been looking at for quite some time and trying to characterize it is the consolidation that's happening with gold. There are a number of pundits out there that are saying gold is just consolidating, waiting to go higher. These the geopolitical economic chaos is ripe for moving gold higher. The dollar coming down again should be fueling gold and pushing it higher. All this monetary spending, the Fed action should be pushing it higher. Yet, it just keeps on bumping its head. How many times is that? 1, 2, 3, 4, 5. 5 times. 5 times gold has hit that, excuse me, that level of about 1750, 1800. Cannot penetrate it. Over and over and over and over. How much longer must it go before those people start losing their faith? How much longer? How much longer can they keep up this charade, this false narrative? I don't know if it's a false narrative. Everyone's guess is as good as the next person's, but I do want to point to one thing that has at least some statistical evidence for this type of pattern. Now, I've often said that, technical analysis without context is really not of any particular use. However, when you're using technical analysis, even with that context, you should have at least some statistical backing. So we have that. And so what I'm going to do is I'm going to provide that statistical backing, that particular pattern in its context with the fundamental context, which may be contrary to what a lot of other people are saying, to predict where I think that gold is going. Now, there is no certainty. I have to give both, maybe 3 scenarios. There's always 3 scenarios where price might be going, right? It could be going up, it could be going down, or it could be going sideways, nowhere. So we'll look at all 3 of those. But first, let's take a look at the gold pattern that I'm talking about. And we'll move right into it, right over here. And hold on. And before you see that chart, you must please like this video, leave a comment. If you're not leaving a comment, say something in that chat, and subscribe if you're not already a subscriber. If you are, thank you very much. Really appreciate it. Hit that notification bell so that you get informed when I do another one of these live streams or post a video. Okay, so what we have here is gold futures. I like to use gold futures. It's a continuous contract. In other words, it's running not 24/7. It's more like 23.5 What that really means is that futures are blanked out each trading day from 5 o'clock to 6 o'clock. But the session starts at 6 o'clock in the afternoon Eastern time and goes all the way around the clock until the next day, until 5, when it shuts down again. Except for Fridays. Fridays at 5 o'clock, the market's closed, does not reopen until 6 o'clock on Sunday. So that's the 23 by 5.5. All right? I hope that makes sense to you. However, it is much better than looking at GLD, which is only opened during regular market hours. And that makes the analysis from a price action point of view a little bit more difficult, because you have these big, huge gaps, and often it does leave gaps in the chart itself. But from a daily perspective or a longer term perspective, you shouldn't see all that. It is, in my opinion, better to look at the gold futures. So that's what we're looking at. We're looking at GC. Now, GC is a contract that represents 100 ounces of gold. So it's a monthly contract, and if you hold it to the end of the month, it is a good way then to get gold at the spot price, whatever price that you originally bought that contract. Probably the most efficient way to buy gold, if the COMEX is willing to get off their asses and deliver it to you. Anyways, now let's take a look at this pattern. Now, we've been going up on this strong bull run right from almost a year in the making now. Let's see, how far back do we go here? Yeah, almost exactly a year we've been on this bull run since 2019 in late May, early June. We've been on a tear. And then, of course, this was more or less mirroring the markets that were also on this bullish run. So thereby gold retaining the value relative to the major markets. And then, just like the major markets, when the pandemic hit, people ran for cover. They needed cash. So they sold everything. They sold gold. They sold the Dow. They sold the S&P. They sold the NASDAQ. They sold everything. And it all went crashing down. Great opportunity to buy into gold then. And then, since the pandemic, gold has then turned around and said, wait a minute, this is not what gold is for. Gold must be that safe haven. And so people started buying it up, and it went back up. But how much of a safe haven is it actually? The big story, of course, you expect gold to be a hedge against inflation. But there has been no inflation. Even though the Fed has been pumping literally trillions of dollars into the market. And that is because all these people voluntarily have left work in order to protect themselves from the pandemic. We've gone on virtual lockdown, not just in the United States, but everywhere, on all four corners of the globe for you flat earthers. We have gone on lockdown. Well, what happens when there's lockdown? Well, that means that people aren't working. Where does 75% of our GDP come from? It comes from the retail, from the actual producers, the workers. If there are no workers, if there's no retail, there's no GDP, essentially. So we have not been in an inflationary environment, even though trillions of dollars have been spent and pumped into the economy to help with at least some semblance of liquidity. No, in fact, we have been in a strong deflationary period. Strong deflationary, a big sucking sound. Deflation. That's what deflation sounds like. So this presents a quandary. You have those who are unwilling to admit this and just want to see the bright side of their gold position, saying it should be going to the moon, and then the reality of deflation and unable to bring the market above a certain, the market just can't go any higher, although it has been going pretty gangbusters lately. Still, gold is in this quandary. It's hit this level over and over again. If we spread this thing out and just take a look at just how incessant this is, it's just spread it out, and maybe what we'll do is we'll give it the 4-hour chart, because that provides a little bit more detail. So now we need to squeeze it in a little bit more. There we go. There it is. Just a little bit more. All right. So there's that consolidation that we see here. Now, what do we see? We see what looks like maybe a rectangle or a flag. Really easy to identify. Let's put a ring on it. No, let's put a rectangle on it. All right. So what that is creating is something that we might call a flat top or a rectangle top. And let's refer now I've given you the I've given you the fundamental context of where I think it is and the reason why it has not moved up any further, and that's because, well, there's indecisiveness. People think it should go up, it shouldn't go down, but it should go up, but the market's saying no, it shouldn't go up, it should go down, and so here we are rotating around this price level, wondering what the hell to do. Now, where is this likely to break? Well, if we put this into further context, and we see that this is, in fact, this rectangle after a sharp move up, and then go to the my favorite site, the pattern site, Thomas Bukowski's pattern site. He does have a very, very specific pattern that follows this very nicely, and that is the rectangle top. Important bull market results. Now, this is not. Now, most people might think that this is a bullish pattern, a bullish consolidation pattern, but it is not. When you've hit that top so many times, it becomes the rectangle top chart pattern, or the flat top, as I would put it. So, the break-even failure rate for up-down breakouts, 15, 30%. So up breakouts are very are in the minority. Pullback rates are far higher. So there's almost a standard deviation, almost 67%, 66% that it's going to be moving down. And the percentage of price targets hitting the target. So in other words, if it does break up or down, more likely to break down, that there is a 78% chance that it will hit the target. Now, this is based on 500 perfect trades. In other words, they all have this contextual buildup, not the fundamental contextual buildup, but the technical or price action technicals. So the shape, prices have flat tops or flat bottoms, crossing the pattern from side to side, following two parallel trend lines. All right. Price should touch one trend line at least 3 times and twice on the other trend line, using distant peaks and valleys, but be flexible. Trends downward 70% of the time. Oh, volume trends downward 70% of the time. Now, has volume actually trended down in this particular case? Let's take a look. Let's bring in volume. We have volume profile up here. We can see, first of all, very clearly that volume is kind of low compared to volume over here, which is high. So I would imagine that when I put in the time-based volume, I'm going to get something very similar. So we'll go to built-ins. We'll look at volume. We'll put volume in there. And we can see. Yes, volume has trended down. So volume is very high here and lower here. Although I guess you could say that's trending down, right? Is that trending down? I guess the easiest way to really determine this is if we can put a moving average. Let's put a moving average on that. And give it a long tail moving average, like 30 period. That doesn't do it? Moving average length. Can I see the moving average? Oh, volume, there it is. Well, the moving average is hard to see. Let's see, maybe if we go to a higher time frame, like a 50 period. I don't know why I'm doing this, but hey, whatever. Doesn't really change much. So there's our moving average. I guess you can say that that's trending down. Really looking just flat. But that's 76% of the time it would do that. Now it says breakout here, upward 63% of the time. But that seems to contradict what happened, what they said earlier. Maybe I just misinterpreted it. But he's showing in the chart, that it's generally breaking down. That's at least his example case. Now here's a case where it's moving up. All right, so this is what I have to say then by this analysis. It appears that about 63% of the time it will break up. The rest of the time it will break down. So that maybe that is a slightly bullish case. Now I don't know about the average rise decline, break even failure rates, percentage price meeting targets. But he provides a chart that makes it look like it's breaking down. Isn't that interesting? Since the breakout can be in any direction, wait for the price to close outside the trend line before taking a position. All right, so there's the key. Wait for the price to move outside of the trend line. So in this particular case, please like, comment, subscribe now. I'm waiting. Do it. Thank you. So in this case, we have these two trend lines. We have the bottom part of the rectangle and the top part, and we're waiting for a breakout on either. Now, I guess then whichever way it goes, now I would constitute a breakout, anything probably that, oh, I don't know. Does he define that? Let's see if he defines that. If the rectangle is tall enough, buy at the bottom trend line and sell at the top one, then reverse the trade. Tall patterns perform better than short patterns. And I would call this a relatively tall pattern. Rectangles, regardless of the breakout direction, perform best when the breakout is within a third of the yearly low. Very interesting. A third of the yearly low. I don't think that we can say that. As a matter of fact, I would say that we're in a third of the yearly high. He also says that a partial rise predicts the downward breakout 75% of the time. A partial decline correctly predicts an upward breakout 79% of the time. So a partial rise or fall within there predicts the opposite inside of the chart pattern itself. So let's take a look at that. Now, I guess that's a hard one to even determine there because, we've gone up, down, up, down, up, down with partial and full. This is so confusing. Where is it going? All right, I'm going to give this a 50-50. Largely dependent upon what's going to happen in the near future. And I'm going to wait for another one of these partial rises or partial declines for the next one. Because we've gone up and down so much and have this so well defined. But it would seem to me that a good trade would be to go short at about 1774, or actually anything above 1760, which would define, this other, that's sort of 1760, a little tighter triangle or a rectangle. I would say you go short anywhere between there and 1770, 1760 to 1770, go short. And then go long anywhere between 1680 and 1670. That seems to make a lot of sense. So we're probably within the very, very close to the short range right now. Almost. I would start shorting at 1660 or 1760. Right? That seems to make a lot of sense. At least the odds will be with you in that case. All right, let's go back to the big head. All right. So there's gold. There's gold from a technical analysis backed up by a sketchy fundamental context. And it's sketchy not because of my ability to analyze it, but because it just seems that everything is up in the air right now. Quite frankly, we have competing things going on. Why are you playing gold if you think it will pull back to 1400? It can take weeks. Well, I am not interested in playing gold per se. And if it does pull back, then that seems to me to be a good play to start accumulating more gold. Now, Frank, if you're part of the Asymmetric Advisor membership service, then you would know that gold is one of our key elements in our Dragon portfolio, our recession-proof portfolio. And if we can get gold at lower prices, or if we can make a trade that will give us more cash to buy more gold and get us up to that gold allocation, which is in general much higher than most other people's gold allocation, then we can fulfill at least part of our requirement at a good price for that Dragon portfolio, right? So I am interested in gold, but I am even more interested in gold for the equity portion of our portfolio, where we're investing primarily in natural resources. And so I'm interested in, from a gold miner's perspective, and a royals and streamers, as well as other natural resources. So gold is playing a key part in our overall portfolio decisions for that recession-proof portfolio. Now, if you're interested in learning how to create a recession-proof portfolio, or engage in the natural boom and bust cycle that is dominant inside of natural resources like gold or other metals, precious metals, as well as industrial metals, lithium, aggregate, all kinds of things, and you want to take advantage of those boom and bust cycles, then you should join us in a free webinar this weekend. And the link is down below. You'll see it, asymmetricadvisors.com/webinar. And the first half of this webinar, you're invited. Now, we do this webinar every weekend for members. But this weekend, we're going to invite guests. And you'll be able to attend the first part of that webinar. And what I'm going to do, just for you coming by, is I'm going to give you one of our trades. Now, our trades have very, very high percent probability of actually fulfilling their goal. And our goal in this particular one is up to a 10-bagger. So we're going to be giving away a trade that potentially could be a 10-bagger in the future. So that's what you'll get for attending that webinar. So hopefully, Frank, that answers your question. All right. That's about all I've got to say. We're going to make this a relatively short program today. I want to thank you very much for hanging out with me, looking at this gold analysis. Where are we here? I've given you some direction in terms of things that you can do with gold. If we get up into the, I'll repeat, if it gets up into the 1760 to 1770 range, I believe you can short for a short-term play. If it gets down to the 1670 to 1680, we can go long. And I think you play within that range. Now, if it's breakout, you can hold it right up to the edge. And if it's breakout, then by all means, take it. If it's a breakdown, by all means, take it, hold it. But I think that right now we're potentially getting into breakdown territory again. Now, I'm going to say, when you say 63% up, 37% down, slight edge to the ups. But I would say that given that this is a self-induced lockdown and we're starting to go back to work, this is not something like a huge quagmire we're trying to figure out we know what to do. I would say the chances are that gold is going to come down. And then once the market starts, and it's going to pull back significantly. That's my primary scenario where I think it's going to go. So there we are. I'm finished blathering about. I hope you got something out of this. Please smash that like button right now. Go to the like button and smash it. Do that. Do it. And join us at the Asymmetric Advisor webinar tomorrow at 1 p.m. Eastern Time, where I'll be giving a trade that normally I would just be giving this to our members, but I'm going to be magnanimous and give this to the general public as well. Show up. And if you think the Asymmetric Advisor is something that you would like to join, you're going to get the opportunity to see what we do within that membership. And you'll even be able to talk to members there. There'll be plenty of members there. And find out if this is something that you want to do. Be part of a natural resources investment membership club. All right. I want to thank you very much. Been nice having you here. Nice seeing you. I hope everybody has a great weekend. We got to hit that off button. Adios.